Hey, how are you now? James here. Just a little bit of a direct to the desk thing. I haven't done this one for a while now, so I thought I'd just kick it back off and get straight into it, trying to do more of the YouTube stuff. Check out the channel, subscribe to whatever you've got to do to whatever you've got to do. Having a really close look at valuations today with regards to the US market specifically and seeing what's going on over there. We've seen half of the companies have reported so far. It seemed to be okay. Now, this is the conversation that people are saying. It seems to have been okay. Expectations have been beaten. However, this is the thing, you've got to remind yourself that expectations were actually lowered at the beginning of the year. So the stats that I had here was going back to the 6th of January that was showing that there was an estimate for fourth quarter 2022 earnings, which is what we're seeing now, to be downgraded, so lowered by about 4.1%. Now, we're about halfway through earnings now in the US. We've seen that companies have reported earnings on an aggregate of 0.6% above estimates. So that's great. So people are saying that fantastic, things are above the estimates. There's beats, stocks go up when there's beats. However, keep in mind that we already were thinking that it was going to be down about 5% quarter on quarter. So what we're seeing here is in fact, so I'll just read this here. In aggregate, companies are reporting, this is from FactSet, great work. FactSet, check them out if you can. And you should be able to. Companies are reporting earnings that are 0.6% above estimates, which is below the percentage of 1.5% at the end of last week, below the 5-year average of 8.6% and below the 10-year average of 6.4%. So in visual form, actually, let's not knock this out. And in visual form, the S&P 500 is reporting a year-on-year earnings decline for the fourth quarter, year-on-year. I think I said quarter-on-quarter before. It's year-on-year. Year-on-year earnings decline for the fourth quarter 2022 of negative 5.3%. So that's about where people are saying. So it's the first time since the third quarter of 2020 for obvious reasons, and that was when things were down about 5.7%. So that was during COVID. Now, so this is sort of what people are saying. So don't get fooled with the earnings expectations being beaten. Expectations have been lowered so that they can be beaten. It's the old trick in Wall Street. It happens all the time. It's nothing to really panic about, nothing to get enthused about, nothing to misjudge. It's just that the fact that it's just these little things that they play with the research that can come out and the analysis that can come out. If we're going to talk about future earnings of the S&P 500, I'm all about this today. So this is trailing earnings I'm going to do first. So the trailing earnings for the S&P 500 is currently sitting at, and I had it here a second ago, it's sitting at about 20, almost 21, so 20 and a half times trailing earnings. Now, that's right bang on in line with its with the 10-year average for that. So, and it's way below the 5-year average. So the 5-year average of the trailing price to earnings ratio for the S&P 500, there's a lot of letters, is in that 23 times number. So it's actually trading right now about where it would be considered to be not cheap, not expensive either. So it's back to it. So anyone saying that the US is still cheap at the moment, probably a little bit wrong when it comes to averages. However, that average things do tend to rise as it goes along. Keep in mind also, if you just want a reminder of just how crazy things can get, at the absolute peak of nonsense, the trailing earnings, price to earnings ratio of the S&P 500 was in that 35 times number. So it can get much higher when things are much sillier. However, interest rates were zero back then and everyone was sort of a little bit funny. What was happening at that time? Oh, for the record, the forward PE ratio, which is one that you should really look at because that's basically what's going ahead, is at 18.4 times, which is bang on the 5-year average. The market has stopped being cheap. That's what I will say. What was happening back then in 2020 and 2021 was that, remember all the kids with their stimmy checks, the $600 checks or whatever they had, they were buying call options. Those call options were causing what was called a gamma squeeze. Market makers had to, as stocks went up from the call option buying, that was meaning that market makers had to buy to hedge stock in the background so they didn't get stuck with a complete blow up if the stock got out of hand. It's called a gamma squeeze, and so you've basically just got to delta hedge your way up, and it's just called, effectively the buying of the call option is in enough force that it actually forces the stock to go up, which then means that more people see that the call option buying is a good way to go about it, and that kept that circle going. And it's sort of like a dog chasing its tail all the way up through the roof. That's what happened then. A little bit of that going on right now, actually, in the US market, especially in tech over in the States. The rationalization of US tech, 6-7%, up to potentially 11% for Facebook. Absolute rationalizations there, getting rid of all the fat middle part, not the salespeople, which is amazing. It means that people are looking at these stocks as well, going, you know what, this is some valuation, some value add that's here. trading on ratios that were okay to own, trading on numbers that were okay to own, and tech is absolutely there. Google, one that I've owned for a long time, sort of got rid of it while all of this trouble was going on, may reconsider going into it again if it's got its regulatory troubles out of the way, and I don't think it does. But there's a few stocks, a few names that are out there that you might want to have a look at. However, there's also a short squeeze that's going on too. Sorry, this is going a touch long. There's also a short squeeze that's going on. Those cautious trades to the downside by funds, hedge funds, being unwound, also pushing those stocks up too as they get unwound, less of that sell side pressure coming into it. So you've got a bit of a gamma squeeze from options trading, also with the short squeeze pushing to the upside. The risk is to the upside in these stocks. However, then you've got those job numbers that dropped, 500,000 new payrolls created. That really, well, it's actually more than that, but anyway, it was way higher than expected. Basically put water on everything that had been said, or not everything, but most of what had been said in the market before that last week with regards to cooling of inflation, that the economy is slowing just enough for maybe think about interest rates dropping a touch, or not dropping a touch, but definitely not rising a touch in the future and towards the back end of 2023. Jobs numbers out of the box, the economy is still growing amazingly well. However, here's the thing, there might just be this sweet spot, the sweetest of sweet spots, where the US market is creating jobs and it's just growing just enough, but inflation is still dropping. What if that could be a possibility that can go on? That's a rarity, and if it does, it's going to be a real sweet spot for the market. I'm not saying that it will, I'm just saying if it does happen, that'll be amazing news for the market. Look, for that, I think that it's possible to have a look at some defensives at the moment. I'm looking at some defensive ETFs, some trades into Europe, and also so basically some consumer staples too. So people still need to buy food, still need to buy Pepsi, Coke, still need to buy cigarettes, still need to buy the things that Unilever makes, so food and simple food products like that too. So I'm looking at some of those defensive areas there, just waiting for the trigger to go into it. So that's IXI is the name of the ETF that I'm currently focused on in that regard too. Look, that's all for today. If anyone wants any more information, please let me know. I'm going to try and do more of these things into the market, make them a little bit more exciting. I'm sorry, it's the end of another long Monday and I'm doing these things. So if you've got any feedback or anything that you want to know, please let me know. Also, I'm hosting a webinar on Wednesday next week on the 15th. Please be my guest and come along. Click on some stuff. I've got some great guests from Global X ETFs, from AusBiz, our local news provider for financial news, and also from Stockhead that do an online trading and stock tipping and stock analysis. Sort of like an online magazine, I suppose you could call it. However, they do some great work. So we're going to be talking commodities, copper, global thematic themes, trading strategies, and everything that's very exciting as well. So that's all coming up. Click on the button and you should be able to get yourself along to it. I look forward to seeing you there. Have a good one. Talk to you. Bye.